Now we have reached the final session of the conference, an exciting CEO panel discussion on resilience and growth, moderated by none other than the distinguished Mr. Hatim Maskawala, Managing Director at BADRI. Joining us on the esteemed panel are 5 industry leaders who bring a wealth of knowledge and diverse perspectives to the table. Allow me to introduce them. Mr. Ahmed Nasif, Fidelity United, Mr. Gautam Datta, Wataniya Takaful, Mr. Owais Ansari, Munich Re, Mr. Peter England, Zurich Insurance, Mr. Srinivasan AR, Dubai National Insurance. Please join me in welcoming Mr. Hatim Maskawala and the esteemed panelists to the stage for what promises to be a thought-provoking discussions. Let's give them a big round of applause.
Thanks a lot, everyone. And special thanks to the panel for joining us. I hope... okay, I'll try to speak up now. Thanks a lot, everyone, for joining us and for to the panelists. Okay. So for some of you who were here last year, I mentioned a quote that, someone told me that to be a CEO of an insurance company, you need to be a magician. You're balancing a lot of things and you're trying to keep a lot of stakeholders happy. So finally, we've been able to manage to get 5 of those magicians out. And starting with the question, I wanted to give them the magic wand. We heard a bit about the regulations and the regulators. So starting with Peter and going around, just asking all of you, if you were in charge of, let's say, CB UAE, what are the sort of 1 or 2 things that you would want to do or you would want to change?
I think, first, thank you for having me. It's great to be here. It's great to be with BADRI, and thank you for all the great things you do for our market. Really, thank you. I think I would start, we will most likely spend a lot of discussion talking about solvencies and the capitalization of many insurers, but I think what I would focus on is the people nature of our business. I would focus on human capital and talent development in general. So I think that's where it starts. I think if we can attract and retain the best talent, a lot of the things will be much easier to solve and some of the challenges we face going forward. I think the other aspect, what I would be looking at is the digitization and the fact that we become more digital. And I think with more digital tools, we can become more efficient. Our back office and our back end systems can be way more faster and interconnected. And also we can be way more meaningful to our clients in the end. And I think that in turn will then address things like the low insurance penetration, for instance, or the low insurance awareness in general in this market.
Well, again, thank you, Hatim, and the whole BADRI team for having us with you, and congratulations for last night's award. I'm sure it's well deserved. For me, there are a few points, and I'll start a bit by the macro side. I think a very important thing is the actual sizing of our market here in the UAE. I think we're all aware that there's a lot of double booking in some shape or form, through the inward fact, the inward code that is there. And if we don't know the actual size of our market, then the whole strategy for consolidation, mergers, acquisitions, and the whole, I would say, landscape of the industry for the coming years might shift, and that's why there needs to be clarity on this one. The second thing would be a bit more on the, I would say, more standardization in terms of the operations, the financial operations of the insurance companies specifically. And here I can give just one simple example. We've all had the floods. There are reinsurance adjustments post these losses. It's not clear, or it's left to the interpretation of the insurance companies whether these adjustments can be booked, today, tomorrow, or when it's actually get paid, which means that the P&Ls and balance sheets of the different insurance companies would just not be reflecting the same standard. So I think more of these things should come. And then maybe my last point would be, I know that the central bank has exerted a lot of effort when it comes to the embedment of risk management, function and frameworks in the insurance companies, but it's still, and I might be mistaken, there is no, I would say, clear requirement for having a risk management function within the insurance companies. And I come from a background where this is, the second line of defense, and in reality it is the first line of defense, because we should be considering that the business is usually biased. So without a fully functioning risk management function within an insurance company, it becomes a bit more difficult. And from a corporate governance, this needs to report directly to the board. I'm saying this where I saw an example in my company where there was a risk management committee that is made up of the business team. So for me, it just defeats the purpose, right? I would say these are the three main important points from my point.
Assalamu alaikum. Good afternoon, everyone. Thanks a lot for the engaging session in the morning. Since morning, quite informative and appreciate that. That's something we need for BADRI. Really appreciate that. The question that you've asked, first of all, it's not easy to be head of a regulatory body. You are normally always complaining about over-regulation, under-regulation, and so it's, as a regulator, you have to manage and balance the market in such a way that you have the right balance of regulation and growth that you want to target. So I think we have to give it to the UAE that they have done a good job with the regulation. What we need to focus on, two areas from my perspective. Firstly is the enforcement. I think enforceability is the key element that we need to have in this market. And there are three aspects to that. Firstly is having the skills and talents within the regulatory body. I think we need to really, if you see even in Europe, all the regulatory bodies are really upscaling and increasing their size to be able to implement and enforce the regulation in the law. And the same thing has to happen internally with the regulator. Secondly, I think we learned about it, somebody mentioned it in the previous pending survey, which was the knowledge that the board needs to have. That's an important topic because it's always a top-down view that brings insurance companies in the right direction. So I think that the regulator has to make or somehow enforce that the boards and the committees that are actually making decisions are knowledgeable and capable. I think that would be from that perspective. You have to ensure that the market players are abiding by all the regulations that are already in place. You can think about new regulations, market conduct regulations, more sophisticated solvency regulations, or capital management regulations. But before going to the next level, the current regulations have to be adopted. So that's the first part of the enforceability. A second part, which I think Peter also touched upon, I think is we need to have a very robust digital insurance framework, because that is what is going to bring about the right adoption and the penetration in this market. You already see that, I think today, the adoption of technology in this part of the world is much higher than even the developed world. And that allows us to offer insurance solutions to the right target market. That would be possible if there is a right regulatory landscape which allows insurance companies to understand what is the data security topics, what are the cyber security topics, and how are you able to optimize data and technology to approach customers.
Thank you, Ahmed. statement that Rafi made, which was something about being efficient. I don't know whether I should take it in a positive spirit or I should take it in the spirit that I'll have to kind of use with my board very soon to try to explain the budget for next year. But considering that the question was based on a wish pool, in case you, so like all wishes, you should not limit yourself. Like go for it. At the end of the day, we all know that what's the phrase, if wishes were horses, then beggars would be kings. So let me give it a shot. So I've used my 42 years of insurance experience in insurance industry as an excuse. We have unnecessarily complicated the business of insurance. When I joined the industry, I was taught that the basic definition of insurance is spreading the loss of you over there. So at the end of the day, it's not rocket science. It's about making sure that we have the right pool from which you can pay out all the losses. There's nothing more than that. You don't need forms. You can actually tell you that. But unfortunately, we managed to do it. So if I was given the role of being at CPU and I to already do something, I wouldn't do something original. This has been done in our neighborhood. If my memory serves me right, a few years ago, Saudi implemented a regulation, Sama implemented a regulation where after the insurance companies faced massive losses and reported all their capital, they implemented a regulation which basically forced every company to provide an actually certified pricing report for their products and insisted that they could not sell the products outside of that pricing report. That's all I would do. We have a half-yearly pricing review report signed by every board. I would make sure that every board followed faithfully the pricing report. And I think half the questions and the observations that came up in the previous session of SWOT analysis, I think you'll be able to solve through that. But that's wishful thinking, and I'll let it go.
Good afternoon, everyone, and thank you, Mr. Hatim and BADRI team for inviting me, and Mabruk for the award yesterday night. Well, yes, as Gautam just said, and Mr. Wise also said, being a regulator is not easy. Now, the role of the regulator is to ensure that the industry they are regulating grows in a healthy manner. That is to say that the people who are the different stakeholders in the industry all are working properly and doing what they are intended to do. Of late, we have seen certain new regulations that have come up in the industry, which are global standard, right? But then there are 2-3 things which are holding us back from seeing the effect of those regulations. One, it's good to adopt a regulation which is global standard of the best of the countries who have a history of 150 to 200 years in insurance. The companies, the operators there have a large level of self-regulation. Now this market, we are relatively a nascent market. We are in 40 years of age, which in insurance industry is still a baby. Along with that, we also have, for various reasons, an extraordinarily large number of players for the size of the market. Coupled with that is various other factors which we don't want to go, like transient management, people moving, the population management keeps changing. There is no real longevity in terms of getting the implementation done. So at this stage, apart from the regulation which are there, there should also be certain other kinds of enforcement by which we ensure that the companies there actually operate on a proper basis. What Gautam said about actual pricing is very good. And then maybe we need certain other kinds of carrot and stick principle, like Again, our big brother neighbor Saudi did in terms of flood after they were faced with similar floods that we had in April. They put minimum deductible in the market. They put minimum premium for that particular risk in the market, which we don't have here. It's good to say that we are a free market economy and we will do that and we let the companies regulate themselves, but it's not happening. If certain other things would be that, I think some of my colleagues here have already covered it, yes, it's good to have good regulation, but then the regulation has to be followed up with scientific and orderly enforcement. We don't have people. I'm sure the central bank is new to regulating insurance. That's been given to them a couple of years back. They need to have more good insurance regulators on their board. I believe they recently moved one gentleman from DFSA to there. That I believe is they are already aware of it. They have started the process of doing that. So, and another major thing which I would like to see is we have wider level of engagement with the stakeholders, the insurance stakeholders. If you look at the banks association is very strong. And no banking regulation comes unless they have a couple of dialogues, iterations back and forth. But it's not happening with the insurance industry. They at best send a draft, people send their responses, and they file the responses. And the law comes as they have been wanting. But we need to have more regular dialogue where they are more accessible than the management. I think we were supposed to limit to 2 and I probably exceeded, but then these broadly are my. Thank you.
Thanks a lot for that. I think that was quite insightful points. As Emirates Insurance Federation also, I think we are trying to have a continuous dialogue with the regulator, trying to highlight the issues that the industry is facing. And so I just want to come to more specific questions right now. Like there was a lot of focus about having, let's say, there are too many companies. In the morning session, you also saw that the size does matter in case of insurance. So I'll start with Uwais, if that's okay. Like in terms of UAE, do you feel that there could be fewer larger companies in UAE, and because you guys deal a lot with, I guess, on the structured solution side as well. So maybe from other markets, what has your experience been?
While we quote as magicians, there is no magic number for a number of companies in a market. And I think if you take a step back, and I think Shri mentioned that regarding the number of insurance companies, if you look at the more established markets historically which have been working, let's look at India, for instance, which has a slightly higher population than Dubai or UAE. It's 57 companies. I think we look at Pakistan, 250 million people, and there you have around 30 to 40 companies altogether. Saudi, we heard about the number already today. So definitely 60 companies for a market size of 11.5 million people, it is, I think, too much. Having said that, I think you cannot have only large companies operating in a market, because you need to have a balance between size, competition, and innovation. And it's normally these small niche players which are much faster and more agile, and they come out with niche solutions which the larger players might not be able to do. There are definitely advantages of having more consolidation in the market, and we see the drive of that consolidation happening in Saudi, for instance, and I think eventually you will see that in this market as well coming through. The advantage of consolidation is that you get a much stronger financial insurance company. You see a company that has better governance structures, better capital and solvency management, and last but not least, the economies of scale, which basically might translate into a more competitive product for the end consumer. So the size does matter, but I think you have to balance it with other smaller, but most importantly, properly regulated capitalize and solvency managed companies which are able to bring in innovation and have niche solutions for the market.
Right. And Gautam, since you have been through a few mergers yourself, any insights on this side?
I think one thing I'll take from what OS just now said, there is no magic number. But it's very clear that if an insurance industry has to be one of the core services that it provides to the economy, then it should have the financial strength to go over that, to tide over some of the shocks that the systems face during this kind of a journey. And unfortunately, the more fragmented the market is, then more vulnerable it is to these shocks. And I think this is where especially talking in the context of this region, where the banks and the insurances differ, because the banks over the years have been able to now, some of the historical backgrounds could be critical. The local banks have been strongly supported by the local government, which has helped them to create a strong financial base. The insurance industry, on the other hand, has been mostly driven by private capital. Therefore, they have not always had the access to the large government funds in order to create that financial base. And creating that financial base means creating that infrastructure, the skill sets, to ensure that the risks that are written are kept within their structure and actually use the capital that is put for those kind of businesses. So I think there is that gap. And at this point of time, by most of the regulators, the kind of requirements they are putting in through solvency regulation, I think is driving the company in that direction. Of course, the changes in the reinsurance market does bring in that whole concept of forcing the local insurance companies to look at their own capabilities in managing those risks. Our experience, and ours was one of the interesting transactions because it created a structure which is not very common in the market, which created a insurance holding structure running 100% of two subsidiaries. But the principle is the same. The principle is creating that economy of scale in order to ensure that things like you mentioned governance, things like development in terms of technology, in terms of product, things like ensuring a level of service to the customers. And then more importantly, the ability to bear shocks when something like April 15 events take place. So it's essential, but again, there is no fixed formula for that in terms of what the market size should be. I definitely agree with OS in one thing, and I'm experiencing that to some extent, is that you do need small companies, nimble companies to adapt, to innovate. As we grow bigger, I can see that the process and the structure takes over. And sometimes the ability to decide quickly does get sacrificed in that process. So it has to be a healthy balance of the two. Now, who can manage that? Yes, regulator definitely has a role to play. And I think the important part that Srini mentioned earlier, regulator definitely has to step up the engagement with the stakeholders on a partnership basis, not as a basis that we tell you what to do, or we tell you because we have to be seen as a global leader in the global financial industry. So if IMF is coming to me, I'd like to show that we are on par with the developed world, whereas we haven't really built that infrastructure up. So the things that we have to then do actually cost a lot more. And again, that brings us back to the ability of the current insurance setup being able to handle that.
And Peter, like as Zurich, you've seen different regions. So anything you can add from this perspective?
Yeah, from a Zurich perspective, so we have then a significant footprint in the US, and then we have the majority of business would be spread out across Europe. So that these are our main sort of two markets, if you say, as a business. I think what we've seen, I think what comes across from, as we sort of conclude this year, is that the retail markets across Europe are facing significant challenges in terms of profitability. And again, it's driven, we mentioned the April floods, is driven by other kind of cat events that you've seen across Europe. So we are addressing this in various ways. I mean, technology is definitely one of them. And the other thing is then sort of strategizing and looking sort of what's next. For us, it's about being more relevant in sort of new segments. It's we mentioned segmentation in terms of mid-market or SME business is a big priority for us. And also the kind of specialty business that you see us do in places like the DRC is becoming more important. I do think that some of the takeaways from some of the April events, we've seen some treaty reinsurers moving away from some of the working layers. We've seen slight sort of rate increases in pockets as well. I do believe that the insurers, particularly the leading insurers, still have a lot of commercial leverage to draw upon in the treaty renewal. So I think that we shouldn't expect too much in terms of rate increases overall. But I do think that on the back of this is a reinsurance need that becomes a bit more specialized, right? So on the back of that, I think the good thing, part of it, if you look at this market, then yes, there are a lot of companies. In essence, and as was mentioned, competition is a great thing. Competition is something that makes us push harder and ask ourselves every day how we can become relevant. But again, it needs to be on the right terms, and we should definitely not sell something that we can't service in the end. That wouldn't be right.
Thanks a lot for that. I think shifting gears a bit in the SWOT also, we saw a lot of focus on digitization, on new technologies coming up, shifting towards AI, robots doing everything for underwriters and all. So if we were to think about digitization, and we hear this word a lot in strategies, so Emmett, if you can add something from your experience, because you've come from slightly from this background as well, as to what are the biggest priorities when it comes to digitization right now for you?
Thank you, Hatem, for the question. I think there are a lot of buzzwords that are floating around these days in our technology and in our industry and all industry, generally speaking. But I think what is very relevant to our industry is that insurance companies are always accused of being thieves, right? Which is very funny, because when you look at the margins that the banks respectively make every year, you would see that the smallest bank in the UAE is making a net profit that is equivalent to the top line of mid-sized insurance companies in the same country, right? Which means that our margins as insurers is becoming thinner by the day. We struggle. A company that is operating at a 97, 98% combined ratio is actually a good achiever. And in a volatile investment market, this is very risky. The price is the price, the market is the market, the losses are the losses. What you can, I would say, better manage is probably your expense ratio, or maybe where you can have a bit more control on. And if I would be prioritizing digitization in any sense, it would be more on your operational capabilities, so that you have a leaner process that would entail, I would say, a lower operating expense, which means that you can better control your margin. Now, hopefully, you can be able to prioritize this in the sense that you can also serve better your customer, to try to change a bit the perception that we have on our industry. For example, in what we're doing now at the company that I work for, is that we have this kind of slogan, and I really hope that if other insurance companies are convinced to follow suit, what can be automated must be automated, as simple as that. It doesn't make sense anymore to focus on 10% of the market, for example, that you need to only tackle in a manual way. If I can do 90% of the market space in an automated way, that's where I want to play, because this is where I can control margin. So it's not 100% driven from a customer satisfaction perspective, which should be the case, but it's more of a survival need that we need to control the margins that we have, and hence we need to focus on digitization.
And Shri, from your perspective, because you're also in a company which is changing right now, so what are your biggest priorities when it comes to digitization?
Yes, adding on to what Ahmed just said, it's basically to ensure that the customer experience comes out best. You know, one is to ensure that we disseminate our products ASAP and make the whole process experience seamless, and also at the end of the day it saves the cost for us. That's basically just to repeat what it's now the question of survival, because if you don't digitize, if you don't automate your processes, you are definitely falling behind in the race.
And Peter, anything you want to add from this perspective?
In terms of digitization, no, I think it's it's something that comes back as we speak. I think it's something we have looked at throughout over the course of the last years. We speak a lot about the M&As in general, and focus on sort of industry specific M&As, and I think what's also happening in the background, that there's a lot of technology being acquired. And I think the expectation is this will then roll in, and this will favor particularly I would say, on the front end, our retail business, but then on the back end, our commercial business as well. So a good example would be a core play for us, which is the international business. And now with technology and with things like blockchain technology, we can now make sure that, say, a master policy can be mirrored sort of one-to-one with a local policy somewhere around the world. So, and I think this comes a lot of speed and a lot of efficiencies and data insights as well with that. So I think it's an absolutely essential area.
That's an interesting point, because we also, like, a few companies came to us, a company came to us saying that, we've got a very amazing technology and we're looking for investors. So there's a company they want to get acquired because they've got good technology and the investor would get that technology. And it's in a country where the dollar investment would be very low as well. So I think that's also a good sort of opportunity that many companies sort of miss out as well. And just picking up on that point about the insurance industry coming out as thieves. So, when we talk about medical insurance, we as an industry are complaining that it's always the providers and the brokers making money. When I see the financial statements of some of the hospitals groups, the profits that they make, it's more than what the industry is making. That's there. But like, and Gautam, starting with you, like, you've been in medical a lot. So do you agree and do you foresee this changing?
Sorry?
That in medical insurance, the providers and the brokers are making money while the insurers are bleeding. So do you sort of agree with this?
You guys saw the chart a while ago. And you also heard the feedback. The interesting bit is that, the providers and the brokers make money, yes. But the reason why they make money is because whoever is paying for that is not doing it in a manner that makes sure that all the parties come out ahead, rather than one party winning and one party losing. So instead of having a win-loss situation, if one of the party in this supply chain deliberately takes a position of being the big benefit, how would I term it, as someone who sacrifices their own interest for the sake of benefit of the others, then the system will take that. System won't say, no, this is not moral, this is not right, I should do something else. Of course not. So as things stand today, yes, the providers and the brokers have a better leverage from the medical business than the payers do. But that's what I think came out in the feedback for the payers. I think what was it, 71% would like to see a price increase. What stops them? If it's 71%, then we should see that happen. What was the other data point where the price increase is, or let's say the claims increase is 31%, but the price increase was only 25%? Why is it always a catch-up game? Why can't we do it? I mean, I did say that insurance at the end is a simple process of collecting enough to pay, and we may not need actuaries, but okay, we have the actuaries, so now let's use their brains. They do give you a whole analysis of what you can expect. Why can't we follow that? So I think we have a situation right now, and that's where all these corrections need to be made, which is where the regulators come in to some extent to protect the policyholders. Now, obviously, it's not such a simple exercise. There are a number of stakeholders involved. And if you wish to protect the policyholder's interest, and medical is very much an individual person's security, if you want to make sure that the policy that is supposed to provide that security to that individual is properly secure, then you've got to make sure that the other touch points are also properly handled. And I think in that respect, there is a lot of work that still needs to be done in the medical segment. But having said that, does it work? Can it work? Is it all, is it all despair, no hope? No, I don't think so. I think it can be made to work, but people have to wake up.
And just to add to that, I think pricing is one part of it, but once you've priced the policy at a lower rate already, then giving credit on top of it, in this market, one thing I don't understand, why do we need to give credit on the medical policies?
So, I mean, as I said, there are a number of other touch points. We seem to kind of just aggravate the problem by, one, starting with low pricing, and then, in many cases, not controlling the claims part, fraud, waste, and abuse, by then giving all of these credits. So, then it becomes a cascading effect. Everything that kind of follows the other.
Okay.
Yes, so which is one. Now, when you talk about technology, yes, technology can be used to plug a lot of these things without incurring a big expense. So one has to take all of these things into account. So if one wishes to be a meaningful medical player, not on the margin, not on the basis of, I do it on the leverage of a naive reinsurer. If you want to do it on a serious basis, then you need to make sure that you have all the wherewithals. And in order to have the wherewithals, you need to have scale. And that's where the importance of bigger bodies, bigger companies comes into play.
Okay. So I'll turn to Ahmed because he initiated this point, and then I'll ask the naive reinsurer as to whether he agrees with it.
So I think it's a very interesting topic, but I'll take it in a very simplistic way. I don't think that we should be blaming our partners or others on the value chain for our incompetency as insurers. As simple as that. I come from a technical background, and I was taught when I joined the industry that you don't give your pen away, right? So you have your pen, no one is forcing you, no one is, you're not at the gunpoint pricing the policy. So if there is anyone to take the blame, it's us. That's number one. Number two, we are the risk carriers, not the brokers, not the TPAs, not our paying for the DIWA bill. So the DIWA makes money, the landlord makes money, the provider makes money, the broker makes money. They are not in the insurance business. It's not their role to carry the risk to lose or win from the performance of the policy. So I cannot be blaming them. They are doing what is right for their business, what is right for their industry. There is an inherent misalignment of interest that is there between us as insurers and the providers. They would like the patient to stay there as much as possible. It's turning into hospitality business. Now, whether this is the ethically the right thing or not, it is what it is. They look at number of beds and the occupation rate, right? We want the patient to get out of the hospital as early as possible, right? So the misalignment of interest is there. It's up to us to deal with this through the right framework of pricing, looking at it the right way, doing only what benefits our industry, what only benefits our P&L. Same can apply, by the way, to reinsurers. the reinsurer in many cases, especially on medical insurance, they give you what is called the net rate treaties, right? They tell you my verdict cost is X. Now, if your expense ratio, for example, is 20%, but you go and load the policy by only 10% and you're willing to lose money, that's your problem, right? In this case, the reinsurer will be making money, and you as the insurance company doing all the effort, in some shape or form, losing money. So who's to blame for this? So that's my take. I'm sorry, I'm a bit blunt on the topic, but I think we should.
And always from a reinsurance perspective, what do you think?
I must just mention that you make money. No, I think I can only echo what both I think the panelists have also mentioned, Gautam and Ahmed. From a reinsurance perspective, what we definitely see is that there are sometimes players in the market who are not really that technically pricing from a reinsurance support perspective. You always get these cowboys who come in for a year or two, then you have somebody else coming in. They go through the same cycle and they don't learn from that. However, that cycle cannot continue, and this is not a sustainable model. And I think I agree with Emma that you cannot blame the value chain for this mistake. I think what has happened actually post-COVID is that there's been a pressure of high claims and claim cost, and pricing pressures have been there. So that has impacted the insurer and the reinsurer, not as much the providers and the brokers. And that's why I think this thought comes into play. Having said that, this can be fixed. This can be fixed by use of technology. As I think, as I mentioned, the FWA. You have to be able to cover that. You have to be able to monitor that. And that's where reinsurers who are providing not only capacity but services and technology, that is what differentiates from a normal reinsurer to a quality reinsurer. And this is where the market will eventually move into. You will see pricing pressures every now and then, but as long as you have a good alignment of risk between the insurer, reinsurer, you'll always see both of them benefiting from a business pool.
Thanks for that. So during the SWOT analysis and even during our discussions, we heard a lot about Saudi Arabia. We are doing a lot of comparison between the UAE and Saudi insurance market. And at the same time, we've seen a lot of the UAE players trying to enter the Saudi market either directly or indirectly. So we've seen ADNIC acquiring shares of Allianz Saudi Fransi. We've seen Orient set up a branch as well, so that's more of a direct working. But at the same time, we see a lot of UAE insurers writing inward from Saudi, and we are hearing the market is growing a lot on that side. Peter, let's say starting with you, I just wanted to get your thoughts on sort of cross-border opportunities with Saudi.
Yeah, I think there are a number of things happening here. And I think the main two things, if you look at these new establishments, it comes down to two things. First is the growth aspect, the fact that, as you mentioned, Saudi is growing at an astonishing rate. I think the 22 number was close to 27% overall. You're looking at a market that will look to double in size leading up to 2030 at sort of an astonishing speed. We can all debate whether we think that all of this will happen at once or sort of partly, but I think these number and the kind of underlying potential in the market in terms of, again, the growth, but also linked to the low insurance penetration is attracting a lot of players, right? So, and I think coming back to these new established, surely these are something that they look to benefit from when it comes to these onshore establishment. I think the second thing, and also linked to the risk mitigation, is also, if you look, was last week we had new directives issued from IA in terms of mandatory reinsurance sessions, yes. And this is a big thing if you think about it, right? If you provide a local market or the domestic market with particularly a 30% kind of first right of refusal, that's a significant pipeline. If you link that with the sovereign wealth funds and all these mega projects in the kingdom, so I think it's also a market that will develop, and it surely also has sort of its fair share of challenges. But I think if you link this to a sort of a global picture as well, what I think to a large extent you don't see these fundamentals in many other regions across the globe at the moment. I think, I come back to Europe was one of our main markets, and I would say that Europe is hurting to a large extent at this point today. So I think all these things make that people are very willing to look at Saudi Arabia.
And Shani, from your perspective, do you feel that there is a lot of cross-border opportunity with Saudi Arabia in terms of, let's say, inward facultative or other areas that you work with?
Well, Saudi market is indeed growing, and but for the massive increase in the medical premium in the UAE market in the last 2-3 years, Saudi was the leading in the insurance premiums till 2 years back. Well, their regulation has been very stringent. They've got the number of companies have been forced to merge to reduce to a reasonably small number of players. So that, on paper, gives a good opportunity for somebody to go in there. But then it also means that somebody who wants to go in has to be equally strong and big. So that, as you mentioned, like ADNIC bought Allianz's share, they moved in there, and Orient is trying to, they're in the process of setting up their own thing. Okay, big players can move in there. Now the other advantage, now that earlier the Saudi companies were not allowed to write reinsurance, now they have been allowed to write inward reinsurance. So this is a new factor which allows you to grow there. And then again, from the pure insurance theory principles, if you can spread yourself geographically, it's better to term in terms of spreading your risk and spreading your books. Well, it is a good place to go, but then the people who wanted to go there should be strong enough to go there. And as we did discuss over the course of morning, most of the companies here have yet to have their own house in order to start with. So, majority of the companies rule themselves out for being in the capacity to go to Saudi to do that. So that being the case, yes, theoretically it's a good place to go because it's a growing market with a very vast potential to grow. Both Saudi and UAE have a vast potential to grow. People can go there, but to go there you need to have the strength for which will allow you to go and start doing business there.
And is anything you want to add from a reinsurance perspective?
I think unlike Europe, where you have the freedom of services, where if you are licensed in one country, you can offer services across whole Europe, we don't have that luxury in the GCC market. So if you are a primary player, you will have to commit capital wherever you're going. And that's quite a bit of a commitment, and that's what I think, Shreddy, what you were hinting towards, that you need to have commitment from a capital perspective, you need to have a clear strategy, what you're going to target in that market, because you've got, actually the biggest regional player is from Saudi, we know that. You've got three, four big players in the market who are very strong, good distribution lines, good risk capacities. They retain most of the risk, technology-wise they've advanced. So when you're going to Saudi, definitely Saudi has all the potential. We heard about all the positives. They have the Vision 2030. They have all the mega projects. They're growing in the non-oil sector significantly, so it creates new opportunities. So all the positives are there. But if you want to enter that market, you have to deal with the competition over there. You have to deal with the financial requirements of being there, and make sure that you are able to tap into that market differently, not replicating a Me-Too product in that market.
Just one last question before we sort of open up for the audience. So in terms of IFRS 17, and let's say from your perspective, does your board understand IFRS 17, and how easy or difficult has it been to sort of explain this to them?
Let me start the response with a counter question. You, as the actuary who finalizes the numbers, and me, as the CEO who signs the balance sheet, do we understand IFRS 17?
This is being recorded, I'll avoid the answer.
And again, Hardik, you let yourself into this. You heard me in this several fora before. I'm a very vital and very vicious critic of the whole IFRS 17 thing. Now, having said that, let's about it. The boards, yes, obviously the board members who manage billions of dollars of business across various things do understand, they are quite strong on the uptake. But then they have got used to a certain way of doing over the last 5-6 years and discussing, and whenever we discuss numbers, they will also want to compare what happened last year, what happened 2 years back, how are we today. So we as management still provide them the monthly, quarterly numbers of the IFRS 4 basis. And we also follow it up with the reconciliation between the IFRS 4 and 17 numbers before, because we are bound by law to publish the IFRS 17 numbers. So before we publish the numbers, we obviously give them a reconciliation on this basis. Because they do understand, and probably it will take some time before we can talk only on IFRS 17 numbers, before IFRS 127 comes in. And then we include certain other new professionals apart from accountants and actuaries. Yes, to sum it up in short, yes, they don't understand it fully. We ourselves are finding it difficult to keep up with the changes and what they are doing. But they do make the effort to actually understand, and we help them with these reconciliations and tell them how and why these numbers are appearing different. Because to a large extent, the ultimate number, the ultimate insurance revenue, the final number, the net profit as per the passport, is somewhat similar. In between the numbers go here and there because they get pushed into different brackets in the different methodology. Yeah. Thanks.
And Gautam, from your perspective?
On a very lighter note, please don't take this question seriously, and I hope there's no one from the regulatory side out here. So can I just understand, have they figured it out, and do they understand it? And the reason is, if they understand it, then why do we submit our e-form on IFRS 4 basis?
Prepared till 2026.
That too is not very certain. No, seriously, I think I was, unlike Srini, when this whole IFRS 17 was being discussed, I was a big proponent of IFRS 17. I thought that would lead to total transparency, harmonization of the financial statements. So to some extent, I have been disappointed. And not because I've not been able to understand IFRS 17, but because whenever I ask my CFO the question, and I think he's here, about something, in order to compare how my KPIs are moving, more often than not, I get the answer that this figure is going to come out of that so-called proverbial black box, the IFRS 4 to IFRS 17 converter. So I think IFRS 17, but to be fair, IFRS 17 is still very new. It will take a while for people, for even practitioners like us, to understand the measures as such. But going by the board, and I think I endorse Srini's point, the board has been used to seeing the KPIs on IFRS 4 basis. IFRS 17 does not align itself to those KPIs. Let's take insurance revenue and insurance service items. They are all clubbed, whereas the board is used to seeing it differently. So even we go through this exercise of IFRS 4 and IFRS 17 and a reconciliation between the two. And I think it's natural for this to carry on for a while till the dust settles down. And even for some of the actuarial assumptions, as they're validated over a period of time when you talk about onerous and non-onerous. So it's still too early. But for sure, it has created some confusion in its early stages.
And Ahmed, from your perspective, what would you say?
We have this waterfall, which is basically the reconciliation between IFRS 17 to IFRS 4. And I think this would continue for a longer time. And then it's very subjective, of course. If you have board members who are veterans of the insurance industry, it becomes a bit easier. But when you have board members and shareholders that are more on the investment side, that they can basically eat you for breakfast when you're discussing business, generally speaking. But then when it comes to a more technical, complex matter, it goes down to the bottom question of, okay, how does this compare to what we were doing last year? Are we better? Are we worse? on the old KPI, are we achieving our targets or not? If it's a presentation thing, you know, I don't want to get involved in this. But then I echo what the gentleman said. I think the IFRS 17, at least till now, has been a fiasco. And this is where we go back to the question of what we would, what would I hope the central bank can do. Again, it goes back to the standardization and the clear definition of every aspect of the presentation under IFRS 17, so that at least the point that Dr. mentioned about transparency is achieved. Whether we agree with the method or not, whether we agree that this is the right presentation or not, but at least let's have a uniform presentation across all the industry players.
I think that's quite important, and although it's a principles-based standard, but in this market I feel the regulator needs to sort of prescribe a few things.
I think I don't have a comment on that, but more a question, I think, which is important. Since a lot of the companies, the top companies, are listed in this market, does the capital market over here and the analysts, do they understand IFRS 17?
I think the investor calls I felt still no. They are also trying to understand. So if you look at the principles of IFRS 17, it's similar to other standards which are coming out. Even if you look at IFRS 16, it's on leases. So if you have a long-term lease, you have to create an asset and a liability and then look at the future cash flows. So most of the accounting standards are going in that direction. And I guess from that perspective, the investors would generally understand that. But at the same time, I feel the accounting profession has moved from a sort of a historical cost accounting basis to a more of an expectation basis. So even IFRS 9, we have an expected credit loss. So expectations brings in a lot of uncertainties. It brings in a lot of work for actuaries, so I'm happy about that part. But generally, it becomes more sort of volatile, and expectation of one person versus the other person. It's a very sort of risky thing for the financial statement. Since we have a few minutes, if there are any questions from the audience side?
I just want to conclude with your theme of this conference was resilience and growth. So I'll throw two questions. One specific for OWAS, and the second question all for my industry leaders here. So for OWAS, with technology giants like Amazon, Google, they are entering the insurance space, and through acquisition, of course. How do you see the trend shaping the industry? Could their access to vast consumer data and advanced AI capability set new benchmarks for customer experience and pricing models, or will it pose challenges for traditional insurance to stay competitive? That's for you. If you can answer, then I have second question for others.
Sure. No, quite a good question. And I think, yes, they have the technology and the consumer level data that allows them to understand the dynamics of what to offer and how to offer it. That's something which the giant, because you talk about Amazon, I think if you look at the Chinese market, where this is already live in action. You have the Ping An, you have China Life, they're actually already implementing these big data solutions together with the technology providers. That is in play. You talk about adoption of technology, is around 58% digitalization in China compared to 25% in US. So China is way ahead. We don't hear about that a lot, but that really is a fact. So what will happen? Yes, these companies with the big data would definitely come in and dominate, but they don't have the expertise on the risk management side or risk or the product side. That's where they will still need the insurers and the reinsurers to work with them. One aspect additionally is to think about, for instance, Munich Re. We have been in business for more than 150 years. And this data of the 150 years that we have accumulated, we are not just sitting on that now. I think over the last, I would say 15 years, there has been a very focused approach by the group to have technology-driven initiatives, which now today allow us to have multimodal operations. So, for instance, underwriting front. On the live underwriting, we have a multimodal approach which we have launched in the APAC region, which not only looks at your data from the documents, but from voice, from pictures, and it combines all of the data and brings out an AI-driven prediction of how underwriting would be. On the non-life side, similarly, we have a tool which is an AI-embedded tool called Realytics, which has a similar approach. So I think even the insurance and reinsurance industry is adopting technology to be able to partner with these big giants. Because if you go in competition with them, it will not really, you will not really survive because they have access to the market which you need.
Halfly satisfied, I can say, because it will be a long debate otherwise, because the half I don't agree with you, with obvious reason. But let me ask the second question, and after the lunchtime we can have that debate.
Sure.
The question which I'm asking my peers and leaders
Sorry,
here,
apologies, Dr.
how can insurance leader...
I would like to be part of this debate because my thesis actually,
Sure.
my postgraduate studies was exactly about this topic. So
Sure, we'll do that.
I would like to try to see what is your opinion on it.
No, I like the input of Shrini on IFRS 17 to throw the buck on them, back. So we are going to do with Munich Re. So if you want to be in my side, so then come. Okay, the question I'm asking is, how can insurance leader leverage, you guys, the CEOs, emerging technologies because of what has happened recently when we talk about climate change and the effect which we have seen recently in April and all that, the losses which we have seen. So emerging technologies like AI, or blockchain we are talking about and all those to create innovative solutions that address the growing challenges of the climate changes which is happening now and sustainability we are talking about while ensuring affordability and accessibility also for our customers. That's the question. If you have your say on that. I think Peter wants to reply.
The question was on climate change after.
Of course.
And the impact.
It has happened. And that's the reason we should learn the experience from that. But at the same time, what I'm trying to say that the affordability is a question and the accessibility for customer is a question as well. We have to manage and maintain. We cannot just blame because of this, because we have to keep the insurance industry sustained.
I think one thing that we alluded to earlier was in the sense, the fact that I think the industry in general needs to go from more a product focus into a more of a service focus in general. I think it definitely applies to climate change as well. And I think what can we do? A good example of what we did is when it comes to Madrid as a city and the sense of the responsiveness now after the rains. So exactly, and I think how we engage with cities and make them become more resilient. I think that's definitely one aspect. So that's something that we will look to as we build our sort of resilient service practice within the group. The other thing when it comes to product development, how can we be more relevant and how can we cater for needs for everyone? And I think to new products, parametric insurance is a very interesting topic. We often speak about terms and conditions and disputes. Here I think we have come up with a product that is very easy to understand. That's something that you can monitor, say rain levels if you're a farmer on your phone, and you can definitely see how a product is paying out in a very kind of binary fashion. So I think these kind of tools are definitely something that we're looking at. So I think these.
Started parametric in UAE or Saudi or Gulf?
To my knowledge, To my knowledge, no. I think the experience that I speak about would be, this is something that we see that we're rolling out in Italy at the moment. But I think when we speak about these things, I know what we do discuss here in the region after, but things like cat rules and these kind of things. But I think there are a lot of good lessons learned in other markets now that needs to fast forward this.
Anyone wants to add there? I can just comment on this parametric topic. So I think BNP has now, since the middle of this year, we have a non-life team in the IFC. And they have actually started offering the parametric solutions within the market. So I think that's something which is now, we don't have a client now, I think, but we are promoting that because we have it around the world and it works quite well for the group. So I think we are promoting it. And we see this market to be the right market for that because it allows for having faster claim payments based on predefined triggers. So I think this is a solution which our non-life team is offering over here. I can put you in touch with them for sure.
Yeah, but unfortunately, it's an add-on on your treaty. It's, parametric. So people will prefer to buy add-on. Everybody is cutting corner to bring down. That's a wonderful tool because on the triggers you will have whether for earthquake, whether for wind, you have everything covered. But at the same time, all these panels we are talking about is to be covered by parametric. You have to buy an add-on cover, which normally it's an extra cost, and that's what I'm saying that people they tend to cut corner.
Okay, let me answer that since the parametric came up first. I will answer that first. Now, one thing you should understand that parametric is it's more an all or none rule. So unless the parameter is breached, there is no claim. And if the parameter is breached, there is a total claim. So this lends itself very much for very large levels of insurance. Now let me also, my experience in the 2 years I was on the other side of the table like you, I did have a discussion with the Oman government, the Oman regulator, because if you see Oman, the country, it's a very large country which is open to large amount of nat cat perils and a large amount of economic losses, but very small amount of insured losses. And where the government feels it's morally bound to recompense some of these people who have had losses but no insurance. So this is kind of thing which parametric solution would lend itself. And where the government can buy say $50 million or $500 million cover at a reasonable premium where there is a loss amount there, and then the government gets paid out this, then the wali or the government, they can themselves decide on how to sort of compensate the people who have had the losses. This is what. This did move forward largely because you know how governments operate. Who is to pay the premium? The Ministry of Justice or the Ministry of Human Resources or the Ministry of Finance or the Ministry of Legal? So this is one side of it. To add parametric to a normal retail property policy, how will it work? It cannot work as an add-on. Well, if it is a large industrial risk where, you know, who is buying insurance which is itself reinsured or layers, yes, as an insurer buying reinsurance, we could buy a layer which is parametric at the top or at the bottom to reduce the cost. Yeah. Probably ADNOC or Petroleum Development Oman, where there is a huge mega risk of too. Particularly for retail customers, I don't think parametric is the solution at this point in time. To come back to the first point, what are insurers doing in terms of digital and use of data? Yes, uniquely, the likes of Swiss Re. We are part of the thing which we are working on. For UAE, flood risk is something new. But we already have a study which sort of has done through independent risk companies like RIMS, you have other companies, where they have analyzed the flood data across the topography and you superimpose the political map on top of it, then you get very clearly that this street in Baushir is surely bound to have losses even at the smallest rain. Whereas this street in that side in Oman may not have rains until it is, say, a 10 millimeter rain over a period of 6 months or 6 hours. These kind of study is gone, and these data and this comes at a price. And then we can definitely include the study in our underwriting and the pricing. But will you, as broker, will you be able to sell the price?
My question was to ensure affordability and accessibility for customer while sustaining the price.
Yes.
And you are doing this.
We come back to what Gautam said, the very basic of insurance, loss of any shared by many means, any loss that happens, yes, the many would pay, but then the price next year should be accordingly. But then this is a debate which will go on probably in 2034 when I come as a retired person, as a guest of thing, we will still be talking about this subject. I think I will hand it back to Hardik to.
Thanks a lot. I think we are running a bit over time. I would like to thank the panelists for the time and the expertise as well. I would just like to give a small token of appreciation. And then, since we are celebrating Eid al-Ittihad, so if you can just join us for a small cake cutting ceremony as well. Over here.
Thank you, everyone.